presentation contains current opinions of Moe's Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to this weekly edition of the Compact YouTube Update. I'm your host today, Javaid J. Ansari, Executive Vice President here at Compact Asset Management on September 8th, 2025. As always, if you'd like to receive notification of this YouTube update and also the weekly podcast update, please just go to compact.com, click on Insights. Right at the top, you'll see a field to put in your email. Just drop in your email there, confirm, and you'll get notified whenever we do provide these updates, as we're trying to be your signal through all the noise out there to help you manage your portfolio and hopefully, garner some good advice from not only us, but also from other great financial advisors out in the industry. If you have any questions or would like us to discuss any topics here on the YouTube or in the podcast, feel free to drop us an email at invest@compact.com or just give us a call, 800-388-9700. So we'll jump right into it. Last week market, pretty flat week. Overall S&P just up slightly at 0.37%. Dow down 0.26. Russell had another good week. We've seen for the quarter now, Russell's up almost 10% compared to the overall S&P 500 up 4%, getting close to catching up with the S&P so far this year. But still, if you look at these longer term numbers, it's not even close. Russell's up 38%, where the S&P's up 72%. I like to see this rotation into the Russell. Gives it a little bit more breadth to the overall market, yet I'm still kind of not quite, it's not enough in my opinion to really deviate from large cap investing, particularly with all of the AI investing really being the lion's share of the earnings growth. When you're buying a lot of these smaller cap companies, they're not generating earnings. It's all a growth play. So there's a lot of speculation there. So I tend to like to own companies that are generating nice earnings and revenue. IFA still up for the week. It's definitely the winner for the year so far. I will talk a little bit more about that because there has been some rumblings now about France, their debt situation, Japan, their debt situation. How does that really play out? And I think it ultimately plays out in interest rates, and that's maybe what is one of the bigger catalysts we're seeing here in the United States, particularly with the 10-year breaking below some support levels, and I'll show those on the chart this week, and also that upward movement in gold that we saw last week. So all of these things are always interconnected, and so we want to try to understand them as best we can. Just because things are moving doesn't necessarily mean we need to be moving, but it does mean we need to kind of pay attention and understand why they're moving as best we can. So then if we do feel like there is an opportunity, or if there's potentially for more risk in the market in the near future, that's what will then dictate when we need to make some changes. But overall, emerging markets doing well last week, and NASDAQ also up 1.16. So a little bit of growth, kind of showing it's coming back to the leadership role. Looking at the sectors for the week, communication services up the biggest. Primarily that was driven by Google. Google basically settled some of their antitrust litigation last week. Didn't settle, I think there was a ruling. And basically is allowing Google to be still the main search engine on iPhones. And so that was a big win for Google. Also for Apple as well. We saw Apple shares pop as well. And so you're just seeing as these tech companies continue to get larger and larger, there's always kind of that wanting to kind of break them up or grab and try to see how we can hopefully monetize some of that revenue from the government's perspective. But overall, they're still the most innovative, driving the AI innovation in not only the United States, but the world. And it seems like government doesn't really want to stomp out that growth engine at this particular juncture. We'll see how things play out over time. But clearly things are still, I'd say, definitely tilted much more towards the corporate sector, definitely leading in terms of continuing to kind of dictate where Washington falls when it comes to kind of antitrust and regulation of these big tech companies and just companies in general. So far, if you look for the year, S&P is still up 11.2%. So once again, just an incredible year on the back of the last 2 years. So as long as you stayed invested, kind of weathered through the April tariff tantrum, You've been justly rewarded here. And as we've talked about, I'll show you on the daily chart, might be in a little bit of a consolidation range over the last month as the market really hasn't gone anywhere. Particularly, you look at NVIDIA last week, now it's kind of below its 50-day moving average. The air seems to be coming out of the balloon a little bit, but that's expected. It's inflated so much. The stock market's been going up so much for the last couple of years. One of the best conditions we could have is basically just a stock market going sideways for about 3 or 4 or 5, 6 months instead of coming down, just going sideways, working off a little bit of that valuation premium that we've built up, and then it resumes from there. So seems like maybe we're in that case. Also, with interest rates coming down last week, I think that also bodes very well for the market. Oil, just basically kind of down for the week, nothing really dramatic there. Overall, commodities have been up a little bit since last year, but not seeing a ton of pressure there. One of the biggest commodities we've seen spike is actually for the cocoa plant. Cocoa commodities have actually gone through the roof. A lot of that has to do with, I believe, climate change and also potentially a lot of supply going off market. So that's really pushed up everyone's prices when it comes to chocolate, but not necessarily a global market mover. Now we did see, I think this was the big kind of news from last week, where we saw the 10-year go from 4.23 and around 4.4, 4.2 has been kind of a little bit of this narrow range downside target on the 10-year Treasury, and we closed at 4.1 today, on Friday, and then basically a little bit lower today. And so what that's fueling is a nice rally in bonds. You can see bonds were up 0.93% last week. So if you have that kind of your traditional retiree portfolio, 60-40, bonds are so far have done 6% this year, which is great. Really kind of helped you through that April tantrum going forward. And then on top of it, what I also like is the fact that if interest rates are coming down, that should definitely be most supportive for, you can see, corporates and your regular bonds here. But it's also going to support high yield bonds. And what we don't want to see, and what I've always cautioned about, is the 10-year Treasury going down. And then what would be a recessionary indicator is also if high yield was going down. But that's not what we're seeing. High yield is actually going up. So as long as high yield continues to trend up while interest rates are coming down, this is actually a very conducive environment to work off this valuation multiple. As interest rates come down, that's less of a burden for earnings and puts less pressure on the PE equation in terms of multiples on the earnings that we experience quarter to quarter. And so then we could really start to, the market was getting a little speculative in terms of those forward PEs, and that's what we talked about. If interest rates are going to continue to come down, particularly on the 10-year Treasury, that just makes stocks a little bit more fairly valued at the prices that they are today. Now, not a great timing tool, doesn't necessarily mean we're going to see a big correction or explosion, but it just means that the foundation of the stock market is starting to get a little bit stronger. And prices could still come down, but the speculation within the market has started to diminish just a little bit since last week. And as long as we continue to see this trend of treasuries going down and high yield remaining just flat to up, that's going to be a very, very positive sign that we can really continue to maybe kind of consolidate, like I talked about over the last couple of months, and then just resume back to the upside without seeing any sort of major correction. So this is something we'll continue to monitor here, of course, on Market Wrap, but I think it is a pretty positive development that we've seen so far, particularly from the bond market. One of the analysts, one of the big economic data points from last week was the jobs report. Everyone's kind of saying how it was a little bit of anemic and overall, but you look at basically right here, which is job openings divided by the number of employed persons, it's basically right at an equilibrium. And I would say that really categorizes where this job market is today. You're not necessarily seeing too much demand. You're not seeing too much supply. Everything is just in a nice, I would say, good kind of spot when it comes to overall jobs market. And then if we continue to see disinflationary pressure, like we've seen so far a lot on services, goods inflationary pressure has picked up recently. I think a lot of that has to do with the tariffs. Basically, 4/5 of the tariffs are being paid by U.S. consumers and corporations, not so much by the exporters themselves. And so we're going to get actually a lot of data this week around inflation. And of course, these are the two drivers by the Fed and what determines whether they're going to be cutting interest rates next week on next Wednesday, which right now is being baked in that they will be cutting interest rates by 25 basis points next week. And so how does that affect your portfolio? Well, if you have cash, the cash the yield that you're getting, which is hopefully around 4%, will start to drop each time that the Fed cuts interest rates. So that will drop to 3.75 and potentially predicted to be 3.5% by the end of this year. Still a pretty nice return. I show you the return on overall bonds was around 6%. Cash, you only really want to have a lot of it if you think we're headed towards a recession. And clearly, as we've talked about all year, besides that little hiccup in April, high yield bond market has been telling us that we're definitely not headed into a recession anytime soon. So that's all very positive going forward. So I talked a little bit, we had also ISM numbers last week. I'd say just generally in line. JOLTS, everything looks good. Non-farm payrolls a little weak, but I would say overall the overall job market is very much in equilibrium. I think the inflation data this week is going to be really key in determining exactly what is the extent and how much, not the rate cut we'll see in September. I think that's already definitely a done deal from what Jerome Powell talked about in Jackson Hole. But what is going to be the pace of these cuts, I think, here going forward? I still think it's going to be on the slower side. And these numbers that we'll get PPI on, I believe it's Wednesday, and then we'll get the CPI number on Thursday. So this will really kind of give us an indication exactly, what inflation, where we're seeing some inflationary pressure, and then how that gets into the market. If we do see a little bit more inflationary pressure with these two reports later this week, I think then we see yields, particularly on the 10-year, potentially bounce from the recent declines that they had. We just kind of get back into that range again. Once again, yields aren't just going to move in a straight line sideways. They're going to go up and down to a little bit variation. But once again, if they're really kind of tied right around that 4.2, 4.4 level, very manageable, I think, going forward. So with that, let's just jump right into the technical analysis. You can see last week, basically the market a little bit down on Friday, but then just kind of moseyed higher throughout the entire week. A little bit of a kind of big up day on Friday, and then kind of was basically gapped up and then came lower. Gapped up, I think, on the Google News, and then came lower. But then we're still just at almost 6,500 for the S&P. So really until we get most talked about this blue line here, that's the 20-day moving average. Until we get really below that, we're in a very, very upward trending market. We dipped there maybe a day here, a little bit here in the middle of August. But really, you look at now since this high, and this was the jobs report number, that was the big revisions back in late July. Basically that was at 6450-ish is where we got here. We're basically still at that level throughout this entire time. So the market seems to be consolidating. Not a big issue. Once again, with interest rates coming down, I think that's very supportive of us seeing any sort of major correction, and that's this chart right here. So you can see here, we've been basically kind of targeting, if I just go back to December of last year, this level I've been looking at is around 4.2 on the US Treasury. We've been holding it. We held it in July, we held it in August, and then just these last couple days towards the end of last week, we've seen a big breakdown in the rates. Now, not where we were back in April of this year, and also not where we were back in September and October of 2024. So just a nice move down. You can see I have this whole shaded area here is red, and I have all this shaded area down here is yellow. I think interest rates above 4.4, it gets a little dicey in terms of valuations. Anywhere in this range, we're in a good spot. I think as long as rates aren't moving down because we're headed towards a recession, and that's ultimately why you look at the high yield bond market to get a gauge for that. Rates coming down is very supportive. Hopefully you have added some bonds to your portfolio. We've been talking about now for, going back to 2023, there's a great opportunity to add bonds here, and then earlier this year, but even throughout this year, we had rates a little bit higher back in April and June. Now, if you would have been adding some bonds, rebalancing your portfolio, you're actually making money on your bonds while the stocks are kind of trending a little bit of sideways here for throughout August. So gives that ballast within your portfolio. And if we continue to see interest rates move down, I think that's going to be really positive. The other breakout we saw was also on gold. So gold basically has been in this tight range here. This is GLD between around 320 and then going back down here to around 395. And then we just broke out above the gold. It happened earlier last week and the week before, and has continued to go higher. Now, why is this happening? Well, I do think gold has been on a nice run, and this is a gold chart now going back to the beginning of this year. So we saw a nice run up here all the way through basically until we got to the April tariff tantrum. And then we kind of bottomed out, just went sideways and consolidated. I think a little bit of the sovereign debt issues, when we look at the fiscal deficit here in the United States at 7%, now we're starting to worry about France's, debt situation and then potentially them having a confidence vote here in the next couple of weeks. We'll see how that goes. All of this kind of deficit spending that really goes back to COVID, that has just really continued, is putting more and more pressure on investors to really kind of be very kind of enthusiastic about buying fiat currency, because these countries continue to kind of erode maybe the value of it. But I think you need to always remember that it's an ultimate relative game, particularly between the US dollar and the euro. The reason it's a relative game between those two main currencies is because those are the two main reserve currencies in the global economy. If people are getting a little bit concerned in terms of how the euro is maybe growing and how much debt they have, and then particularly the US as they're continuing to pile on more debt with everything, our fiscal deficit, then people are now starting to gravitate a little bit, particularly central banks around the world, away from US dollars and into the euro. And what are they going into? They're going into gold. And so, as we talked about, I kind of changed my tune on gold. I was kind of a little bit of a, not a bearish on gold, but I just didn't think it was going to appreciate. Clearly, that's not the case. I mean, gold now, if it is being basically supported by central banks around the world, is continuing to do very well. So I think that trade maybe a little overbought here, but I think it's just a little bit of a sign as we move away from the euro and the dollar. This is another chart I'm including this week, is the euro and the dollar. So basically, when this chart is going up, that means the euro is strengthening. So you can see the euro was in a kind of a rough place here back in 22. This is when we saw the major increases in interest rates. So typically when you see interest rates rise, that can really help support a currency. So when the US interest rates, and we had all that inflation, but the interest rates rose, that was really supportive of the dollar, and the euro took a tank. But since then, the euro's been on a nice trend. And I view this chart also very similar. You can see I have a yellow dash here and a red dash here. The reason I've been looking at the euro is because ultimately I believe a sovereign debt crisis, if we are going to have one, like the European Union did back in 2011 and 2012, the biggest detriment to that is going to be a country's currency. Just as in emerging markets, we had never really had a sovereign debt crisis among large markets. We had one here in Orange County, California, but it didn't really affect everyone. I mean, you just kind of defaulted, and you just see erosion maybe of some benefits to the community over time. But from a sovereign debt perspective, where that can really affect people is the value of their currency. And that's why you see in emerging markets currencies, tend to basically inflate away to nothing when they're having a debt crisis. So I think tuning into the exchange rate, particularly between the euro and USD, once again, because they're the two reserve currencies, is really the key thing to tune into. And as long as the euro is really holding some levels, particularly I think this 0.9 level, but even go 1.04, because you see a lot of support at this level going back to 2015 and 2017. As long as we're still supporting and so holding those levels, I think it's a little early games to call any sort of debt crisis on the horizon. So just as we use high yield to assess a U.S. recessionary environment, I think we're also looking at currencies to understand, potentially where there might be a debt crisis, potentially beginning to foster. And then finally, this is one of my favorite charts, the high yield bond chart. Once again, you see things got a little dicey here in April. I'd say the ultimate kind of red line, this would be really an indication that we're headed towards a recession, as if we got there. Gets cautionary around 78, but basically since May, It's just been a smooth uptrend to the upside. And even with interest rates coming down, that should support high yield. High yield's not going to potentially go up as much as your normal bonds, but once again, as long as high yield is trending in this direction, stick with it. Everything's going to be okay. So this week, once again, we get those inflation data. I think that's going to be really important to setting the table for the Fed cuts next week. Not necessarily the cut, but potentially what is the pace of the rate cuts going forward. So we'll see how that all plays out. But once again, if you're interested in receiving this commentary on a more frequent basis, updates on our podcast, or just like to learn more about Compact, just visit us at compact.com and click on Insights. Give us your email. We'll send you out just a quick notification, nothing intrusive. But if you'd like to learn more about Compact, just visit us on thecompact.com. If you'd like to connect with us directly, invest@compact.com is our email, or give us a call, 800-388-9700. Well, that is the update for this week. I will be back with you next week. Until then, I wish you all a very enjoyable week here as the fall is just picking up. And I know everyone's back into football season, which is exciting. So enjoy those games, and I'll look forward to talking to you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.